future. We're talking real money.
Well, if your favorite late-night talk show is on hiatus thanks to the writer's strike, you have nothing to worry about when it comes to talking real money because we have no writers. So no one to strike. There's no problem whatsoever with us. We're going to be here anyway because we just make stuff up as we go along. I'm Don. That's Tom.
Wait, there's nobody writing this show? This is just whatever spews out all the time?
Actually, I take that back. I never write anything down.
Well, that part's true.
Tom, on the other hand, he does write stuff down, but he does not script the show. But he does write notes to himself. And
I
things
do
like
have a lot
that.
of notes.
You're
That's
organized. True. You are more organized than I am.
You know, it's the difference between the media, our media backgrounds. In television, everything was written down. On radio, nothing was written down. So you're a radio guy, I'm a TV guy. There you go.
As a matter of fact, when I started in radio, the thing that saved me and turned me into a talk show host was a woman telling me to stop reading and start talking.
Yeah,
and
relate.
You just talk. Be yourself and talk to people, which is what we do, except we do something different. What?
Do we have her name and number? I'm going to call her. I got her to blame for this?
Dude, she was probably in her 80s.
I'm going to find her if she's still alive.
In 1985. Let's do the math, shall we?
Yeah, all right. Yeah, okay. Maybe she should be president or something. I don't know. So...
we're trying to avoid politics, remember?
I know. Not just saying everybody's running for president's old, I guess. But
remember,
close.
We're not doing that.
Yeah, we're letting it go.
I'm Don. That's Tom. I think we said that part. The thing we talk about, though, here on this podcast is money. Why money, you ask? If you have to ask, then you shouldn't be listening. Because if you have any, or you want some, or you're trying to figure out how to do whatever it is you need to do with it, or retire comfortably, or pay for a kid's college education, or buy a boat or a car or a home, or whatever it is, you got to deal with it. And you know, there are people who are going to deal with you in a way that might not be good for you. So give us a call at 855-935-TALK 24/7. Send us your questions at talkingrealmoney.com. Learn a lot at talkingrealmoney.com. And we're going to try and save you from things like really dangerous investments that get away. They literally get away with lies, with big fat lies. However, the story for most of these investments, it used to be just not that long ago that they tell you a 7% annual return or an 8% annual return with no risk was really good. Well, these days you can get 5 on CDs. So the lie has to inflate. 11%. No, 12%. With no risk, Tom.
I absolutely love the Cliffwater Enhanced Lending Fund, which isn't very big, $1.5 billion. That holds private debt. But here's the thing I really like about it. The document that they use the circular that they offer says the fund has a Sharpe ratio of more than 10 and a beta of 0. What does all that mean? Sharpe 10 and 0. What does that mean? 10. Yeah.
10. Well, the Sharpe ratio is a means created by Professor William Sharpe, winner of the Nobel Prize. For this, the Sharpe ratio is a mathematical means by which you measure risk and return. The risk-adjusted return relative to others. It's a relative number. And anything from 1 and up is a good Sharpe ratio. That's a positive.
So give us an example of
I was going to do that for you.
Yeah, because I'd like to know. I mean, what would be their category?
I looked up online the highest Sharpe ratios for exchange-traded funds right now. Pretty fair comparison.
Sure.
Right?
Yeah.
The Fidelity Select software and IT services portfolio has a Sharpe ratio of 1.45. Let's go up a little bit to let's see. How about the First Trust Dow Jones Internet ETF? 1.53. The Putnam Global Technology, you're going to see a pattern here, 1.62.
So around 1.5 for these pretty risky ventures.
I've got a couple that are pushing. As a matter of fact, let's see, what's the highest? I want the highest. I got to go down here. The highest is a Voya. Now, this is a very similar fund, by the way, except this is publicly traded to this one. A Voya securitized credit ETF.
So these are loans that are wrapped up and sent off to you.
Things like that. Mm-hmm. Yeah. Sharpe ratio, 3%.
Wow. So, okay. But so 10 is a bit off the charts.
Oh, and then, gosh. Yeah. And it's so funny because there's a comment in the article, the Zweig article you're reading, something that Bill Sharpe actually was he asked about this number?
He was asked about this. William Sharpe, the Stanford University finance professor, Nobel laureate, as you mentioned, he said, Jason Zweig asked him about it and said, when he gave him the score, he said, quote, maybe that's Sammy Sharpe's ratio. And Jason Zweig replied, who's Sammy Sharpe? And the professor responded, I don't know, but that can't be my ratio.
Because it's an impossibly large number.
Yeah, it's hard to see. So, and beta,
by the way, is a measurement of risk.
Thank you.
So what was their beta?
0.
Oh, 0. Okay, so literally they're saying we have the highest the highest possible risk-adjusted return ever in the history of any investment and the lowest risk ever in the history of any investment. Now, what does that sound a lot like?
A ripoff? I don't know.
A lie?
I don't know because
bald-faced lie. That's what it sounds like to me.
They specialize in direct loans to small and mid-sized companies. This is part of the boom in what they call alternative investments, and these companies pay 11% or more in floating rate loans. So these could go up as they have, and some loans pay off, some loans don't.
What's the name of this company again, Tom?
This is Cliffwater Enhanced Lending Fund. Cliffwater Enhanced Lending Fund. It's very small, $1.5 billion. And Jason Zweig is picking on them for the reason that you just said. Again, we're getting back into this double digit. You can make double digits. It's going to be easy. There's no risk here. And that is not quite true, not even close. And by the way, you can make almost 5% now in T-bills. So that is fairly riskless to own those. And guess what? Here's the other part you're going to love, Don. The management fees start at 1.25 annually, sometimes get up to 3, and there's incentive fees in which the managers take 10 to 15% of any excess over the target rate of return. And here's even more fun. Guess what? 1/3 of the private U.S. credit funds don't even do any due diligence. They outsource that to others who tell them, yeah, this is a good loan. You're going to be okay. So don't worry, be happy.
One of the questions I always ask when I hear this is I'm going, what kind of companies are paying 12% to borrow money?
Yeah. Guess
even
what
in this environment, what kind of companies? And there was a recent news story that points right to one of them. There's a company that is getting ready to file for bankruptcy so it can restructure its onerous debt. In other words, bail on a lot of its debt, which means the people who hold the debt are going to lose a lot of money, and that is Vice Media. They're getting ready to file for bankruptcy, and tons of money was lent to them at high, risky rates. They don't lend this money out for nothing. They are going to charge through the nose, particularly when they knows that some people aren't going to pay it off.
They knows when some people aren't going to pay it off. This is the kind of thing that we regularly tell people not to invest in. There's a long history of what they call alternatives not doing well. I'd go back and look at 50 years of returns at all kinds of things like limited partnerships, and more recently at things like SPACs or crypto or things that look really great because they're going to make you unlimited amounts of money. Number 2, aren't these the kind of products that hedge funds use, and how's their track record been? Not as good as the Standard & Poor's 500. Yeah. And if frankly, this is one of those things to me, when I read it, it sounds too good to be true. I think it is. And by the way, after Mr. Zweig called the firm out on this, guess what they did? Oh, they rewrote the offering a little bit to say, well, yeah, it's not really that great as they updated the document.
I'm looking at their website, and they are that fund is no longer on their website. However, their Cliffwater corporate lending fund is still there. And here's what the claims are just incredible. They're claiming that investment grade bonds, and this is accurate, that they have a risk, a standard deviation of 5.95.
Which sounds low.
Yeah, but there's on their corporate lending fund, they're claiming it's 2.
That doesn't make any sense. That's upside down. No, literally, because one is publicly traded debt, the other is not, correct?
Right. And they're claiming that their return has, since the inception of their fund, has been 8% per year, while the investment grade bonds have returned a negative 0.5%.
Wow. Yeah.
Mm-hmm. Sounds
Stand
like
clear.
pretty big claims for. And here's the thing: is all of this it's all unlikely. It's not impossible, but it's highly unlikely that any investment anywhere is going to return more money to you for less risk than another comparable investment that is available to the public. If there were magical investments that could return 8% with less risk than regular bonds, then people would be flooding into that security.
There'd be no stock market at the end of the day, because I'd take all our clients 8%, maybe that with no risk, beta of 0. That'd be easy. By the way, Cliffwater has updated their document. According to the co-head of asset management, we decided to remove the Sharpe ratio from the fact sheet as it appears to distract from the substance of the fund.
The substance of the fund, in that you're still claiming to be able to do something that no one else on the planet has ever been able to do consistently. I don't get it. Oh, well, that's why we have questions.
Yeah.
To calm me right down.
That'll
Tom,
do it.
Do you have questions?
Yeah, we do.
I need a calming question.
Yeah, this comes from William in East Rockaway, New York.
Rockaway,
yeah,
out there
Rockaway,
on Long Island.
Rockaway. There you go. Enjoy the show. Find it both informative and entertaining. 57, married, currently working full-time in New York City. As of today, I have $1.1 million in a 401k.
Uh-huh.
Also, $170,000 in an employer annuity fund, $35,000 emergency fund in a high-yield savings account, and $10,000 in savings. No credit card debt, car loans. House worth $600, have about $125 remaining. That all sounds good. But here's where the rubber meets the road. Wants to know about the portfolio. I took a look. He's invested in a Vanguard International Fund, a Vanguard S&P 500 fund, a Vanguard U.S. Midcap Fund, and a Vanguard REIT Fund. So you're
Sounds
missing
like
some asset classes here that are very important.
And you're going to far more effort than you need to get all the right asset classes.
Well, I don't know what all the funds available. This is in a 401k, so I don't know all the funds are available. But if they've got U.S. mid-cap, they for sure have got U.S. small-cap value, because Vanguard has a very fine U.S. small-cap value fund. If they have international, it's likely that they have an emerging markets fund. So you're really kind of focused on large companies. You're too focused on the U.S., and you're missing the value component, which is really something that you don't have in any of those funds, the International, S&P 500, U.S. Midcap, or the REIT fund. You got to get smaller, and you got to get value, and you got to get a little more international for me.
So what does he have outside of the 401k investable assets?
Well, he mentions just $170,000 in an employer annuity fund, and then the rest is savings. There really is no brokerage account.
Okay, he has
where
no
he could own those other
component.
assets.
Yeah.
No.
Okay. Well, because I was going to say, if they don't offer them, then get your S&P, or if they have a total market, just do that. But if they don't, do the S&P 500 and the international, and then get small cap value outside of the account if they don't offer it. And just those three are going to help a lot.
Yeah, because frankly, I would swap out the U.S. mid cap for small cap, as you say. And if you can't get those in the 401k, I think that's great advice, Don. Simply open another account and put them in that post-tax brokerage type account, so you have access to that. That's great.
And another, if you can afford to do it, another interesting thing, you may make if you make too much to be eligible for a Roth IRA, if you could squeeze some more money out, do a non-deductible IRA. But if you can do a Roth, do a Roth. But if you can't do a non-deductible IRA, since you don't have an IRA, it's not going to cause you to pay taxes pro rata on other things. Do a backdoor IRA and then use that for your small cap.
Backdoor Roth IRA.
Backdoor Roth IRA.
Yeah, right. And that's a great place to own that small cap value or international value or emerging markets. Terrific.
You got it.
Great question. Thank you. I guess we call you Bill. He put in William from East Rockaway, New York. Great question. So now I got to say, is it time to stay calm and retire happy?
No.
This is why the writers leave. Okay, please, I'll write it down. Please go.
And then I'm going to go join the picket line because I wrote this. Keep calm. It's like the old World War II poster from 1938. Yes. Keep calm and retire strong.
Retire strong. Okay.
Think strong, big, strong money.
The title of our new class, which is coming up. We have already sold. I can't use the term sold. We sold more than half of the in-person seats already.
Those were free, sir.
I know. So I really can't say sold. Maybe I'll stand in front and try and sell shirts or mugs or something.
We do have shirts and mugs, by the way.
I know.
We're going to have, this will be a class with merch.
There you go.
We're going to have the merch girls. Do we get a merch girl or a merch guy?
Can I sell those outside of the classroom to make a buck?
Absolutely. You just hawk those things to your heart's content.
So keep calm, retire strong. Thank you, Don. Coming up on Wednesday, the 24th of May, if you're listening to us online, virtually, wherever it is.
Which they are. It's a podcast.
I know. So then you simply go to Talking Real Money.
It's not
click
a radio
on
show.
May 2023, I believe is what it says. And you can register right there and you can join us. We will be doing it in person and virtually. It's going to be around an hour with questions. It's going to be a good time. So join us for that.
Yes, it does say the button says May 2023
I got that part right. Thank you.
Or you can scroll down and you'll just see the little poster, keep calm and retire strong. Okay. Click on that.
That's all I got.
If I click on it, what happens? Oh, look at that. Cool. It works. So we've already sold half the in-person seats?
Yeah, something like that. So I knew those would go quick. Those will be gone after this Saturday show for sure.
Okay. Thank you. Thanks for being a part of our little podcasty thing. We're glad that you can listen, and we hope you'll tell your friends, and we will be back doing another one, well, really soon, like probably tomorrow, but it depends on when you're listening. But the nice thing about podcasts is you can listen anytime as Tom, that guy over there, and me, Don, sit around in front of microphones, babbling and talking real money.
We hope you realize that the information provided on Talking Real Money is for informational, educational, and hopefully enjoyable purposes only. Providing personalized financial planning or investing advice takes time, so please consult with a really good fee-only fiduciary investment, tax, or legal advisor. We know a good one. Investing must always involve risk. In other words, you can and probably will lose money at times. Also, as much as you want it, no one can accurately and consistently predict the future, so past performance doesn't tell you a darn thing about what the future will bring. Unlike many other programs that say something similar, Talking Real Money is not trying to get you to buy or sell any financial products or securities. Instead, the program is provided as a public service by Appella Capital, a fee-only registered investment advisor. Thanks for listening, and please visit TalkingRealMoney.com for more information and disclosures. That's a wrap.